welcome to today's extensive weekend video and a warning for S&P 500 bulls. It will be quick, in-depth, illustrated with many charts and covering much in talking but not excessively long in time, so make sure to watch it from the beginning till the end. Let's start as always with the US dollar. We can see it on a short-term basis outperforming and diverging from yields being merely sideways. However, have we seen a genuine turnaround in the US dollar? Not really, and most of the ascent is concentrated in the rise against Japanese yen, which has of course its own reasons tied to the Japanese economy and situation there. When it comes to yields, this is what I mean by saying that they are practically sideways, and if you look carefully at the situation ever since the Liberation Day early April, we see that the short end is still being the more preferred one. When it comes to volatility, and my favorite VIX, the short-term VIX volatility metric, we see that this is not exactly consistent with rising tensions, and I've been as well clear about the easing financial conditions. And this is not just a matter of the United States and the Trump, our so memorable one photo easily recognizable from the Fed headquarters visit. When it comes to Friday, it could be argued that the session was quite lackluster. There was no opening track that would take retail to the cleaners through downswing. Rather, it was straight up, and then towards the end we saw some very modest selling emerging. But however, it was easily possible to navigate it in intraday terms. And now, what to do about it when it comes to the swing trading situation? We see that the rising wedge structure, which is probably the chief, not exactly warning, it's not exactly the main warning that we have for equity prices, but in technical terms it is. And market breadth, it had kicked in, right? And I would not call it any kind of a bearish divergence. However, it's well worth watching because we are not in the seasonally strongest and most predictable period of the year where we could expect equity prices to be just pulling ahead in one direction. However, the pattern of last couple of days had been very nicely visible following the rejection early in the week, and rejection meaning rejection to go higher. We got an undershoot that was equally fast rejected, and since then it has been a very nice grind higher to take advantage of. A bit of a not exactly warning sign, but a chart to watch is this bond market situation, where we see that treasuries, long-dated ones, are underperforming corporate bonds when it comes to junk or quality alike. Junk, it's not that well pulling ahead. However, Friday was a bit of a little bit risk of day under the wood when it comes to the sectoral view. Easily tolerable, but for example, if we remain with materials, industrials and financials, coupled with discretionaries, you can check retail. I've been talking a lot about biotech lately too. We can see that these are enough risk on sectoral engine firing on almost all cylinders, because tech is underwhelming, especially if you look at the same situation from a 5-day perspective. We are seeing more of the risk of bias. Don't be just led astray by healthcare being the best performing sector. It's actually in a long-term basing pattern, and there are some names that are doing quite well and those that are badly underperforming, United Healthcare and the like. So I view healthcare as a bit vulnerable sector here on a short-term basis, to be clear. Tech, it could have been doing better, but what kind of a downline? Serious downline, I don't mean trepidations in the region of 2,000 or 3,000 points, ES points, lower here and there, which is what could be coming next week. I don't mean these kind of moves. However, when you have financials doing this well, industrials doing this well, materials, another sector that I had talked well over 2 to 3 weeks ago as those that had very nicely turned around. You have as well maritime energy, where the bulls are waiting for a long time, and I've been very patient in guiding trading signals clients in not jumping the gun, and so is the case when it comes to precious metals undergoing the correction that very nicely coincides with the temporary US dollar revival. So on a 5-day basis, this is how the situation looks like, and you can see that consumer stocks are distinctly underperforming. You will be able to find the same kind of characteristics in retail stocks as well, select retailers, because bifurcation, that's the more than the buzzword. My joint page will help decide what's right for you based on what and how you trade. Clients get the full perspectives intraday together with daily analytics. Combine these two and you're good to go.